Okay, so today's lesson is going to be a part of what we call the accounting for the entrepreneur. It is the last section, section 11 in the syllabus, and it includes topics like payroll, budgets, cash flow projections. So today we are not going to start with the payroll or even the sales and production budgets. We'll leave that for another lesson. This lesson is going to be on the cash flow projections, which is basically a cash budget. Okay, so we're going to try as much as possible to keep this video extremely short. So if you need to read anything about what a cash budget, what is a cash flow projection, you can pause the video, you can do some research. What I am going to emphasize though for you, besides the format, which we are going to get to just now, is the fact that this deals with cash. So it is cash, the most liquid asset, which means that we are really analyzing or looking at the liquidity of a business. So as I said, it is cash, cash inflows, meaning money or cash coming in to the business, and then of course the cash outflows, which would be the payments, what we spend the cash on. And the business is interested basically for liquidity reasons. Liquidity, if you remember when we did the ratios for liquidity, it had to do with can the business meet its short-term debts because it has enough liquid assets. So short explanation, we're just going to go straight into the sections of what we call, the cash flow projection, the statement for cash flow projection. So the first section would be your cash inflows. It is money that is received by the business whilst it is operating. So you would see any money that comes into the business would be considered your cash inflow, coming in, inflowing inwards. So what are some of the sources of these cash inflows? Cash sales. Whenever you sell for cash, you receive cash. Receipts from customers, loans, capital invested, other income like interest received, tax refunds, dividends received, anything that the business receives in the form of cash, that is considered a cash inflow. So it's receipts of cash, okay? And then we have the opposite, which would be the outflows where money is going out of the business. That is any payments, any money that is spent by the business. For example, we have whenever we purchase our assets for cash, we pay our expenses with cash, payments to suppliers, repayment of loans, investments by the business, payment of taxes. Any payments or any cash money that is spent would be considered our outflow. And then the final section we have, first it starts off with finding what is our net cash flow. So we have cash inflows and we have cash outflows. If the cash inflows exceed the outflows, that means we have a positive cash flow. If, however, it is the reverse and we spend more, so we have more cash going out of the business than is coming into the business, then we will have a negative cash flow. It means we are spending more in terms of cash than we are actually receiving in terms of cash. And obviously that affects our liquidity. So after you have found your net cash flow, then you go to the balances and you will add your opening cash balance, which they will give you for the period, the beginning of the actual period. You will add that to your net cash flow for that particular period, and that will give you what your closing cash balance is. Okay, so there are your three sections. Very, very simple. Inflows you start with, outflows next, and then you have your balances, which includes your net cash flow. So as I said, trying to make this video as short as possible. So here it is, we have an example, and what you would see is that it is for January, February, March, April, May, June. So that means this is a cash flow projection for 6 months. So we usually do it on a monthly basis. So 6 months. And as I said before, you remember our sections, our 3 sections. So the format, you have your rulings, January, February, March, April, May, June. You have your dollar signs because we are dealing with monetary values. And you start with your cash inflows. So you will see your cash inflows, your receipts, cash sales, loan from bank, other income. So those are just 3 examples. It can be anything, whatever cash inflows you have for the business, meaning whatever you receive in terms of cash, you will put it according to the month. So January, you would have seen that they received cash sales of 2,000, loan from bank 9,000, other income 1,000. And then February was only cash sales, March the same, April the same, May had cash sales and other income, and June cash sales. So you just put it in terms of these columns, very easy. Question gives it to you, you plug it in there, your cash receipts, and then you total it up. And then you go to the next section, which would be your cash outflows or your payments, and you just identify it as the money spent, and you list it, and you put the amounts once again according to months. And then you tally that. So you have some payments where you purchase raw materials, purchase of machinery, wages paid, office expenses paid. So these are your payments. Each month, you will see the information there for the different months tallied. Can you remember what the next step is? Next step, we deal with our net cash flow, which is part of the section that we end with, which would be the balance. So your cash inflow less your cash outflows will give you your net cash flow. And when you get that figure, then for each month, you're going to add your opening cash balance to that, and that will give you your closing cash balance for each month. So something that we're going to do in the example, we're going to emphasize, let me start right now. Your opening cash balance, what you see here in January, there was no opening cash balance. So probably for this business, they just started or something like that, okay? So there's no opening cash balance. So it will be the net cash flow for January, which was a negative 3,000, meaning they spent more. So more went out, outflows exceeded 15,000. We only received 12,000. And your closing balance is the 3,000, add the 0, which gives you a closing balance of the same 3,000 negative figure, okay? This is what I want to emphasize for you. Your closing balance becomes your opening balance for the next period, in this case, for the next month. It is the same thing that we have been doing with the accounts. You remember your carry down the figure is your closing figure, and what do? You bring it down and it becomes your beginning figure or your opening figure. It's the same thing. All right, so whatever at the end of the month, whatever closing cash balance you get automatically becomes your opening cash balance for the next period. So what you will see, you go through the process again, negative 1,500, add the negative 3,000 gives you a negative 4,500 as your closing balance. Next month, March, this 4,500 negative figure becomes your opening cash balance. And then you just keep on adding, you get your closing balance, it goes and becomes your opening balance, you add again, and then and so on, and so on, and so on. So this is basically very easy once you remember the 3 sections. Start with your cash inflows each month. Then you go to your cash outflows each month. And then finally, what you have is your net cash flow, add your opening cash balance, which gives you your closing cash balance. So the best way to ever really get something is to do an example. So what we are going to do is this very, very simple example. And you see that we have the information here, natural stuff. And they're asking you to prepare a quarterly cash flow projection. Quarterly means what? 3 months. Okay, so you have your 3 months, October, November, December, and here is your information that they give you. So remembering, we're going to go based on the 3 steps, well, 4 steps, 3 steps, 3 sections. And the first section was to identify your cash inflows or your receipts. So you're just looking at your information and you're going through your information. Cash sales would be a cash inflow. Receipts from credit customers would be a cash inflow or receipt. Purchase, no, is a payment, payments, 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 payments. So you have identified your cash inflows. So when we go to do the cash flow projection statement, this is what you will start with. You will basically have your receipts, October, November, December, and these 2 items. Okay, so the second thing that you're going to do is you're going to identify your cash outflows. So your cash outflows are your payments. And we saw that all the other items were basically payments. So that means that these are going to go under the cash outflows. Nice, easy. So we have those 2 sections that we are going to do. We have identified what items are going to go into those 2 sections. So you have your final section where you start with finding or calculating your net cash flow, which is your cash inflows less your cash outflows, and you will get your figure. And then the final stage would be to add the opening cash balance to get to the net cash flow to get your closing cash balance. So we're going straight into doing it now. Natural stuff. Cash flow projection for the 3 months ending 31st December 2020. We put that heading because this is how they kind of put it here. These are basically budgets and projections are basically internal documents. So we're not as strict in terms of formats. So you don't have to worry too much about the things like that. Make sure still and put the name of the business and all that, okay? All right, so you can put it like this or however the question has it, because as you saw in my example before, I just had cash flow projection and then the months, that's okay. What's really important is what we are going to do next. Remember, we start with the cash inflows. So we identified our cash inflows. So we are now going to put it here. Your heading receipts. And we have these 2 items. So the first one, cash sales, and they have the figures for each month. What was our cash sales for October? 32,000, for November, 90,000, and for December, 108,000. Move on to the next one, our receipts from credit customers. October 12,000, November 15,600, and December 20,000. If this seems like if it's too easy and you're wondering what's the catch, there is no catch. It is that easy. Okay, so this is it for your receipts. You just add up for each month. So you have 32 plus 12,000, 44, and then 105,600, and then 128,000. So these are your total cash receipts for October, November, and December. Okay, and you can put a line and you're going on to your next part, which is cash outflows. We identified 1, 2, 3, 4, 5 items. So you put your heading, it's payments. And you're just going to list these and put the amounts according to the months. So purchase of non-current assets. Notice there's a 0 here because there is none. So you can put 0 or dash, it doesn't matter as long as you have the figure. December, there was no purchase of any non-current assets. Next one, payments for credit purchases. You put the figures according to what they have for each month. Utilities, 3,600, 4,000, 4,000. Salary expense, 25,000, 25,000, 30,000. And then finally, advertising expense, 1,000 for each month. And there we have all of them. So you just tally. Remember, we draw a line every time we're going to do a calculation. So we draw our line and we add up for each month. So you can pause if you have not done this before, you haven't seen another video on it or whatever. You can pause and you can actually check my calculations for me. And you can always just let me know if I have anything wrong. But I think I checked and I double checked, but we all make mistakes, right? So these are supposed to be your totals, your total payments for October, for November, and for December. And you draw your line. So you have step 1, your cash inflows, which are your receipts. Step 2, which are your payments or your cash outflows. Now you go to 3, you calculate your net cash flow. So your net cash flow would be your receipts minus your payments, your totals. So for each month, 44,000 minus the 39,600 for October. So what we have here is net cash flow, and this minus this, 4,400, the 105,600 minus the 121,000, negative 15,400, which is shown as, it is shown by having the brackets. Okay, what you see here is the payments in November exceeded the amount of receipts. This is why we have a negative cash flow. Okay, so a negative figure, brackets, to signify that it is an negative net. And then in December, we exceeded it by a lot, so we got a lot more receipts than we made payments. So you have positive 83,000. You can pause for a little while. Okay, and now we go to the 4th and final stage, which would be to add your opening cash balance. Now they usually will give you at the beginning of the period, which is October. Remember, this is for the quarter. The quarter starts in October. So we will look at our question, and what you see here, the company forecasts that the bank balance will be $10,000 on the 1st of October. Now, just to point out, they use the word bank here. Bank is near cash. So when they're talking about cash flow, they will be talking about cash, the most liquid, and then bank is very, very, very close to it. All right, so don't let this confuse you at all. This is your balance for your opening cash balance, October. So we have $10,000, so you just put it $10,000. We do not have the opening cash balance for the other months. So what we are going to do now, from now on, we are not going straight across and plugging in figures. We are going to do our calculations per month. So we have our net cash flow, 4,400 for October. We have our opening cash balance, $10,000 for October. So you're going to add these two, and what you will get is your closing cash balance, which would be 14,400. Pause. We are now going to go to November. Where do we find our opening cash balance for November? It is the closing cash balance for October. So you're going to take this closing balance and you're going to put it as your 14,400, because the closing balance at the end of the month, 14,400, is the opening balance for the next month. 14,400. Okay, and then you just go back to adding. So you add your negative. Remember, it's a negative figure. So 15,400. Add your 14,400, and that will give you a negative $1,000 as your closing cash balance for November. Take a pause. Where are we going to find our opening cash balance for December? As we have gone on to December, it will be your closing cash balance for November becomes your opening balance for December. And then you just add as normal, 83,000, add your negative 1,000, which means it's 83,000 minus 1,000. And that will give you a closing cash balance of $82,000. So at the end of the quarter, this is your closing figure. So we can just put our double lines and stuff there, and this is what it looks like, all colorful. Remember, first section, cash inflows or receipts. Second section, cash outflows or payments, money spent. And then third thing, we had to just find our net cash flow for each month. And then the final stage would be opening cash balance, starting with this opening figure. Find your closing balance, and your closing balance becomes your opening for the next month. So you add your net cash flow with your opening, get closing, and then closing becomes or goes forward into the other month as the opening cash balance. And then you add it up again and you have your final closing cash balance. Nice, easy, simple. Once you take it one step at a time, then there you have it. It will be great if we get it for exams. Okay, so best of luck with your studies, guys. See you next time.